that 5,500 number, but it doesn't necessarily reflect how you think the year is going to end. Are you going to take a look at your year-end targets now?
We are, Carl. At the early December last year, we thought S&P could reach 5,200 this year, which at the time was almost a 20% gain. We've obviously moved well above it, and the fundamental picture to me looks stronger. I think earnings next year, we originally thought would be 260 for 2025. It's probably closer to 275. I think the war on inflation has been meaningfully better in terms of progress. I know there was a lot of dispute, but I think the last two inflation reports and the fact that 55% of inflation components are back to pre-pandemic levels means inflation is really going to fall like a rock. These are factors that give us comfort that multiples can expand. And so I think 5,200 is clearly too low, but I don't know how much above 5,500 there is into year end. So I think in a couple of weeks, we'll be addressing that.
You actually use.
There you go. Inflation's going to drop like a rock, but what exactly does that mean for the stock market and where things could go? That's exactly what we're going to talk about today. If we look to SPY or the S&P 500, we're currently up by 15% so far this year. Here's what's interesting. When we're up more than 10% year to date in the middle of the year, our hit ratio for the end of the year is 82%. And on average, we go up by basically 8%, and the median is 10%. But this gets even better because when the S&P returns more than 20 or more all-time highs at the midpoint of the year, the ratio is also really good, 80% hit ratio, looking for either 6 or 10%, which means the market could go dramatically higher. Or maybe it's 1995, as I've been talking about before. So yesterday we went through and talked about the bearish scenario. Well, here's the bullish one. Since 1928, the first 15 days of July have been the best two-week trading period for the year in equities, and they start to fade after July 17th. Okay, so what does that mean? Well, it basically means that we could hit my target from December, maybe in the first 2 weeks of July. I was looking for 5,600 as my target going back to December of last year. And wow, if we hit that target, maybe I'll have to ratchet it up to 6,200, which was the mathematical number. So this is looking very spicy. And I will come back and look at exactly what I think Tom Lee's mentioning regarding inflation dropping like a rock. But he also mentioned multiple expansion. Well, that's what we see here. Today, we're looking at 30.8 for the PE for tech stocks. We could go up to 55.5 if we go to 2000. And then finally here, the AI bubble forming, not formed. NVIDIA's right now trading at 47 times forward PE, and Cisco traded at 196, or hundreds of times lower. So is it 1995? Can we hit this 5,600 target? And if so, this will be particularly important because we hear from the big man this week, Jerome. I'm going to go through and explain my point of view really fast, but it's a debrief from yesterday. So Jerome Powell is going to be speaking on Tuesday, but on Friday, we're going to be getting unemployment. I think this is going to be important because look, Jerome Powell speaks on Tuesday, and then on Wednesday, we actually close at 1 o'clock. But at 2 o'clock, after the market closes, we get those FOMC meeting minutes. And then on Friday, after we're closed on Thursday, we're going to get non-farm payroll. So what this basically means is that whatever Jerome says on Tuesday is likely going to be what carries the market for the week. He'll be discussing central banking. And right now, people don't feel rich because the common man CPI, or the cost of things you need to buy, like food, energy, shelter, utilities, insurance, they're going up faster than you're getting paid, or the employment cost index. So yes, we're seeing progress on inflation. We're seeing the first tick lower in a while. And look right here. If we go back to the saying is that the first inflation peaks it gets better as we go through the first quarter. If we look here, there's been no progress made basically since the beginning of the year. If we go back to last year, well, December, January, February, March, April, nothing really happens until we get here to June. June, July, August starts to drop like a rock. Notice that big decline there? That's exactly what Tom Lee thinks is going to happen again. So if it does, it means we're probably going to be on target pretty soon here. And we still have really strong GDP with a meeting happening in July on the 31st. But then we have September and December to look forward to for a potential cut. So this is pretty much a Goldilocks scenario. I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up or subscribing to the channel, I would greatly appreciate that. Thank you ahead of time. So I think Jerome's going to be a pretty happy guy. I want to see what he says on Tuesday, but as of right now, the market is pricing in a 58% cut. So what if it is 1995, where fundamentally and technically the targets that I laid out at the beginning of the year are now looking a lot more likely? Remember, last time we rallied by 220%. So if inflation drops like a rock and we note that the market still wants to go higher, well, why can't we go higher? Well, we definitely can. Last thing I would note here is that we talked about rising in the first few months of July. Well, that means that we want to get above 551 or into a monthly higher high. All that means is that the market is going to be in a blue sky breakout over resistance and will have an easier time continuing to go higher. So if the first 2 weeks of July are going to be strong and we get above 551, all we're going to look for is the same pattern we've been looking at for a while, a fail breakout. If we get above 551 and hold it, bullish. If we get over 551 and lose it, bearish. Very, very simple. Okay, well, same thing for the NASDAQ. So if the first 2 weeks are strong, and then after that, it's to be determined, let's just be mindful of those dates. And like I said, we're going to have the FOMC coming out after market close on Wednesday. But then, ironically, with that July 17th date, this is where I think it's going to get interesting. Netflix kicks off earnings for big tech on July 18th. And then we got Jackson Hole coming out later in August. So whatever Netflix does, kicking off earnings on the 18th is likely going to really matter. Here's what I want to see. If we look at the last 3 months, we note that, yes, outside of mega caps, meaning the biggest stocks in the world, the Magnificent Seven, there's not really been a broad-based participation. But if we look at the last 1 month, it's getting better. It's not good, but it's definitely getting better. So that's what I want to see more of. And then finally, if we look here to the pattern we looked at on the weekly chart, I think what's going to be very important is whether or not NVIDIA is able to actually continue to form hollow candles. If we look here to our pattern, let's just bring it back for 1 second. This right here, which means we had 11 consecutive hollow candles in a row, led to a really nice rally. Over here, we've had 8 so far. So what this really means is that after we lost after we lost that previous high or failed breakout, just like we had happened here, and has happened here as well, this took 4 weeks and we declined by 20%. Over here, we've declined by roughly 15 so far. So it happened over the course of literally days. And if we're going to see the move finish, here's what I'm looking for. I want to see us recapture this low. I want to see this inside bar break bull. Why? The first 2 weeks of July are supposed to be the best ones of the year. If that happens and we form another hollow candle next week, all we want to see is that pattern continue into here. Not a lot to really talk about beyond that. So thank you very much for tuning in. Maybe you want to click the video on the left or subscribe on the right to hang out with me at 9:15 a.m. on Monday. Thanks so much.